Okay, hello and welcome to More Talk. This is the end of 2023 and the beginning of 2024. Throughout 2023, the second half, 2 p.m. on the East Coast. And what time on Thursdays on the West Coast, Michael?
At 11 a.m. in the morning, just in time getting ready for an early lunchtime special here.
And I think it's been a great year. We haven't or wouldn't be able to do it without Adopt the Brand.
That's right.
A company that Michael and I are both part of, and which offers many solutions to lenders or bridges the gap between what they're used to hearing through traditional resources with today's modern movement, whether it's in technology, whether it's in alternative financing products you may have, or just ways to go out and reduce cost or increase revenue through adoption. And it's been a great journey here in 2023, Michael.
It's been pretty amazing. I mean, from the rise in interest rates to trying to figure out how companies are surviving into 2024 and looking forward to 2025.
Yeah, and I think the first article we wanted to cover was the cutthroat mortgage business in 2023. And many have said in 20 years, no year has compared to it, I think is what Ben Cohen in the article from Guaranteed Rate said. And a big part of it was coming off the banner years and then going right to a thinning origination volume, mostly because you'll see the stats here, but low inventory and just a lot of people equity locked, which we talked about on a lot of our episodes.
It's interesting, it's been termed the interest rate lockdown. And I want to compare this. I live in California, of course, you're in Massachusetts, but in just around at the end of 2019 and 2020 in California, we had 70,000, just above 70,000 available housing units listed for sale. At the beginning of 2023, we had about 40,000. So, and then throughout the year, inventory went from 40,000 to about 45,000 to the present time. But you take into consideration, even with the higher interest rate environment that we have right now, 4 years ago, at technically lower rates. And so we still have an inventory crisis that's going on, at least in California. And I suspect that California is fairly similar to the rest of the nation when it comes to inventory. So we can't say that what was going on this year was a result of interest rates. And what I mean as far as funding units or sale units, what it really was is that we're still in this inventory crisis, and we have a continually we have a social demographic of available first-time buyers that is still growing. And people saying that deposits are lower, well, that in relative terms that could be true for the higher net worth people, but I was looking at actual savings. This is in the St. Louis Fed, they call it Fred. The actual savings amounts that are going up for lower investors, meaning that not a high net worth investor, but that amount has been increasing over the last 12 months. So the first time buyer pool of the amount of savings have been increasing. Debt's still been increasing, but that when we talk about first time buyers, I think the first time buyers are those that are in preparation of buying a home. So they're managing their debt cycle. You can use products like FinLocker, or you can use other types of products. We talked about it last week for budgeting and preparing for home ownership. But for the most part, we've seen an inventory crisis and buyers that are still on the sideline. So we saw lower units this year because buyers on the sideline. We saw that in the rising savings amounts, and we saw some increase in active listings, but we're only talking about 7 to 8%. And when you're talking about an all-time low of inventory units, that just means that we're going to have lower units for sale.
Yeah, 40% of all U.S. mortgages were originated in 2020 or 2021, according to that article, Black Knight data here. Shout out to Housing Wire is where we got the article. So the customer pool by 2023 had obviously decreased. 90% of mortgage holders had a rate that was less than 6%, and 80% rate less than 5%, and almost a third had a rate less than 3%. And then the result of that is, according to Ingenious data, tens of thousands of loan officers left the industry this year. 67% of current loan officers are doing less than 1 unit of closed loans, at least in October. So it's probably even less in November, probably a higher number, I should say. And then an additional 21% closed 1.5 units per month. So only 12% closed more than 2.5 units in October. Probably only 10%, in November. And when I talk to leaders in the industry recently, I think one piece that comes up is how it is such a transactional industry at the end of the day. And if you can't solve for increasing transactions, it's very difficult to resonate with loan officers and maybe real estate agents as well, traditionally, with long-term solutions. And I think the biggest example I see here in 2024, as we talk into 2024, is the opportunity for pent-up pre-approval. I don't think ever has there been more pre-approvals and pre-qualifications that have gone to the wayside than entering 2024 because of the factors we just talked about. Many people looked and gave up. And we are a transactional industry where if it's not going to close in 60 days, it's on to something else. But these lenders are sitting on all sorts of previous pre-approvals. And when you think about it from a customer acquisition standpoint, they obviously trust you. They've given you all the information before. You have brand recognition. You have a connection. You've spoken with them. The cost of acquisition to, replenish that existing relationship, go back through and find out what the drivers are. Are they went back to renting? When is their rent lease going to be up? I mean, that must be most of it. So I think that's one where I look back at 2023 and talking to a lot of people, they're looking for, is there a solution there where you have a loan, and I'll land this plane, but you have a loan officer that has had these months where they've only closed one deal. Are they going to, in February, have the energy, have the financial assets, savings to go back and grab those, 100 pre-approvals that did not close, didn't find it, and work on those? Or are they just going to go and call the latest lead because they need to close, because they need to catch up on something? And that's the cyclical problem that I think technology, like you had mentioned, is coming out to solve. But is it a little late for 2024? And like we always say on the show, and hopefully people keep coming back, it's important to point out our show has evolved since it started here in 2023. We now have redistributed it on podcasts and on Sundays on YouTube. And this show, for example, we do live listenings, but this one, Michael, I didn't invite anybody to, because I can't invite everybody every week or I will be a spam in their inbox. So I just posted on the news feed and then mostly focus on our Sunday rerun here. But what do you think of that? Before we dive further into this article, what do you think of pent-up strategies here in 2024 because of unconverted leads in 2023?
I think it's a social problem versus an economic problem. And the reason I say it's a social problem is that if you go back 10 years ago, Michael, not only did we have more inventory, but you had loan officers / salespeople that were willing to get on the telephone and make the phone calls. I could see how if in this past year, you had a buyer, especially in California, they had $200,000 or $300,000 that were willing to put down. I'm not talking about like an FHA, 3.5%. I'm talking about like people that are willing to put down hundreds of thousands of dollars, fully qualified, looking, working with the buyer's agent, and then I want to wait because I want to wait till rates come down. Prices are going up, and I want to wait till prices come down. I want to go against everything that says that the economy is good, everything that says that is going to be for my benefit, housing prices going up, and I'm just going to wait. And it's just, and the loan officers and buyer's agents, by the way, this is a two-way street. They just couldn't put it into their education holster and say, hey, you know what? Prices are going up. Rates are going up. You should be happy that rates are going up, because inflation means that you have higher prices. And if you have higher prices, that your housing price has a high potential of going up too. So if you're against inflation In other words, if you're going to wait for rates to come down, then you're also begging that prices come down at the same time. How are you going to wait until prices come down to a certain bottom? What, you're going to wait for that $800,000 house to go to 720 and dropping? So you're going to try and catch a falling knife? That makes like, I'm going to wait for that stock price to keep going down. So in the meantime, you're going to keep renting, you're going to keep renting, you're going to keep renting. And that's great. Stock market's done pretty well this past 6 months, but you're still renting. And if home ownership is part of the deal, then the buyer's agent and the loan officer is not providing the buyer with the proper amount of education. And in this coming year, Michael, with NAR going through all of those issues, it's going to be super critical that the buyer's agent provides more value with their mortgage originator and educating them what's going on with that market, right? Because with that whole legislation, the lawsuits and all that stuff that's going on, the buyer's agent needs to be more educated with the loan officer and be, instead of working against each other, can I get a commission? Can I share a commission? No, this is a time that we need to work together with the buyer and figure out how to work with the seller's agent now that that those the cooperative broker agreements aren't going to be shared on those commissions with the buyer's agents. How is that going to create more sales? Well, as long as the buyer's agents get on the ball with the loan officers, get on the telephone and work their butts off, which they need to do no matter what, then they're going to create the sales. I think that's part of the problem too. They're just not making enough phone calls.
No, that's a great soapbox. I think we are starting to on the reruns, get questions from home buyers. So if you're a potential home buyer and you're looking at loan officers to work with, real estate agents to work with, please use this as a medium to understand the questions you should be asking and more the landscape that both sides are working with. This allows you to see behind the cloak of mystery sometimes that you feel is part of the mortgage process. This is in some ways a way to have an understanding of what the advisor's thinking, of what you should be thinking, and why, if you feel stuck, listening to this podcast while you're searching for a home can show you you're not alone. Let us get you in the mindset to make the right decision. On this article, and I'll give you an example here. I'll give you the article. Hunter Markwart, and I apologize if I said it incorrectly. Hopefully he comes on the show. If correct me if I'm wrong there. VP over at Cross Country Mortgage said 20 and 21 were how quickly a lender could execute. Meaning you applied, they had to close it because there was a backup and people were just lowering their rates, and then they were doing it a lot digitally. So it backed up, everything's digital. But now we're back into where people matter. And he is pointing out 2023 is about understanding the buyer's motivation, the ability to qualify and determining where you go from there. And I would say, you also said like every scenario is different. Sure. You as a consumer are doing yourself a disservice if you stop at just filling out an application. You should be pushing your loan officers, and this might be a big narrative for us in 2024, push them to do a little bit more research once they know about you, because there are programs out there that not the loan officer's fault, but because they can't know every program, but there are new programs that were really popular as we recap in 2023 around bank statements and debt service loans that are not really what you would consider subprime. I would consider them opportunities along for your loan officer to give new advice. Especially there's new rules now around FHA 203K loans, which is a a renovation loan by the home. There are so many places where there's so little inventory except that one house that looks like a haunted house. These are, assuming it's not haunted, your chances to fix them up and get the home without little competition. But 2024 is either going to be about a lot of competition and great rates, or rates are higher, less competition. Listen to this show, why you should lock in. And I sent an article over to Mike from, I'm going to call it a birdie that we're going to have throughout the year, but we'll call him Rockin' Robin. He sent me an article to share with Michael, our specialist here in capital markets. But when he sends something, I know it's coming from DC. I know it's true. We'll go over it, but it gives you a little prediction of the rates moving forward. What are your thoughts on that, Mike? And if you're scrolling through the same article, you're kind of knowing where I'm going to go before we go on to that one.
Can we stay on this topic before we move on to the rate part? And I'll bridge that in a second here. But on the C-suite level, from the executive level down to the street level, the originator, there's a disconnect on educating the originator on the types of products. You just mentioned the FHA 203K. What about the VA construction loan? What about USDA construction loan? What about the non-QM loans that are out there that can put money into the pocket of the home buyer? What about the bridge loans? Bridging them that are non-QM available, that originators like, well, what's a bridge loan do? I thought it was this, I thought it was that, and whatever. Because there's different types of products that are out there. And Wall Street put it out there, and then someone in capital markets at an independent mortgage banker is going to say, yeah, we'll take on this product. This looks pretty good. And they put it out there, and then maybe they work with marketing. Maybe there is a serious lack of education to the originator. And if it goes from the originator down to the realtor, down to the consumer, you still have buyers that are out there thinking that FHA, well, oh, you can do 3.5% down. I thought if you still think it's 20% down, that just tells you how watered down information is from Wall Street to IMB to originator to realtor to consumer, and I consider the consumer also mass media, television, and internet. If they're still thinking that you need 20% down just to avoid the MI, but never get into a house, then there's a serious disconnect on information from the marketing department. And I think that when executives are saying, hey, go push out this product, you have to have the originators that are only doing one a month, right? You still have top originators. You have, the top 100 LOs that are doing more than that. But the ones that are only doing one when they're used to doing 4 to 8, there's a lack of education of not at the originator level. There's a lack of education for them to educate realtors, and then the education to the consumer to actually utilize those products.
In this article, Michael Ullman from Movement Mortgage says loan officers, myself included, who have worked with a lot of first-time buyers and have working knowledge of various programs, whether it be FHA, Home Ready, Home Possible, bond programs, down payment assistance grant, they're staying busy. Where it normally was 30%, he's pointing out, now making up like 80%. So that's right in line with what you're saying.
Yeah. In fact, I was just talking to a referral. I had to give away this FHA loan referral because I'm not doing that anymore. And they're like, well, we have a 3.5% mortgage, but we have $100,000 of consumer debt. Our house is worth $850,000 and we only owe $400,000, and we don't want to get rid of our 3.5% interest rate. And I'm like, well, you're negatively amortizing your bank account because your combined income is only $10,000 a month. And they're like, because $100,000 of consumer debt, according to their current debt schedule, is $2,800 a month in making their minimum payments. $2,800. If you borrowed $100,000 to cash out on a first trustee, even at 7%, $100,000 is not $2,800. So, and I said, look, you're as a consumer, you are giving yourself a financial torture. It's death by 1,000 paper cuts. I think that's the saying. And I think that's what consumers and homeowners are doing. Well, I want to wait for this and well, what about this loan program? What about down payment assistance? What about if we do a 2-1 buy down? What about if we do this and this and this? All these programs out there, and they go, what? Well, too confusing. So what is it that, because you're not buying it, when you buy the house, you don't buy it for the house, you're buying it for the payment. And so when you really begin to understand, for those that are actually looking at that, when you're buying the payment and the tax deductibility and all the benefits that are behind it, I don't think there's enough of originators out there right now that have that type of education. If they had that type of education, we would see it on the news because they would see it on the street. Anyway, so for that purpose, I think that we need to, the executives need to, and marketing and originators need to collectively come together and say, what can we do to educate, not just, how do we get this in the mainstream media? I don't know the answer. I'm on my soapbox. This is something Dave Savage has been talking about this since they put Mortgage Coast out there 15, 20 years ago.
Herrera, who joined us earlier, was talking about he's in the new build, the construction world, and
in Texas.
So you have a lot of people that he's competing with a lot of builders, right? And so they're funding the sellers are actually funding the temporary rate buy downs on a case by case basis, but the builders are definitely doing it. So if you're in that world, you need to know how to explain it to them. You need to be very thorough in them understanding, what that means, what the options are. But it's a good time, as he pointed out, even to get a new build with rates being a little bit higher. You have some more options with the assumption that the rates are going to come back down at some point. And it gives you these, there's a lot of 2, 3, 4-for-1 options where a loan officer can get a refinance out of given the right program here if rates go down. And I think consumers listening need to be aware of that and form a partnership. I mean, this is good. The idea is in probably half of the proposals that you're going to work together again. If you're getting new financing now, be a little bit closer. Don't disappear. Work together and have everything in line so that you can have a goal and accomplish it in 2024 around your home.
Michael, I got a question for you. Do you think that if you're a loan officer and your buyer goes to new construction, do you still think you need to chase after them? Or do you sit there and go, you know what, I lost them in new construction, they're going to beat me on rate, and yeah, I worked all this time, but you know what, I'm going to cut my losses and I'm going to go call 20 more people that were already pre-approved with me and get them back on the fence and get those 20 pre-approved buyers that kind of were on the fence, and then call the 20 realtors beyond that, so I can work on my future rather than working on sour grapes or lost apples, whatever you want to call it.
I don't know the direct answer. I would say 85% chance.
No, I'm asking for your opinion. What are you doing? What are you going to do?
Asking for the no up front, but understanding that there's a lot of headwinds. One is, I think there's going to be a lot of rate poaching. So you lock them today or you get them in a program today. And if that's going to take a little bit longer to completely close, you're going to lose them. If you don't have the right build, construction to perm programs, you're going to lose. If you're not allowed to use the same rate buy downs, you're going to lose. So yeah, I think it would just be try and offer value and advice and sort of this plan to work with you and give them the option of, even if you take the current financing, do I have permission to stay in touch with you because I think rates are going to go down. I think, there's going to be another program. But the gentleman from Zenith, the guy who runs Zenith Home Loans, great content he puts on LinkedIn. But he just reminded here coming into the new year, sales is a numbers game. So for every minute you're not working on that. And that's why AI is going, and we probably won't talk about it too much on this show here, but if we had more time, 2024, AI, I don't think is going to run anything too much in underwriting. I think it's going to get riskier. I think the government's going to crack down on it more and more.
Sidebar: AI companies are up 33% in the last 60 days on the stock market. So,
I think there's going to be a lot of AI in. For every hour you can cut out, outsource to AI is another hour you can spend increasing your numbers needed to get sales. So, I think AI will be in scheduling. I mean, I think scheduling is one of the biggest messes in lending from my research when I was, running an app for 32,000 loan officers. You have a schedule in the LOS. You have a schedule in the company calendars on Outlook or wherever it is. Every person has a schedule on their own phone. And then if they have a Gmail, they might have a schedule on Gmail. And nobody knows how to sync them all. That's why I'd adopt the brand. I'll give you an example. You need somebody from the outside to come in and just do the blocking and tackling, the ABCs, the 1, 2, 3s. Just train them all on how to sync up their calendar, or go out and spend $49.99 per user to have a sync, right? I think that's the problem. Is there's old school alternatives to avoid these large tech spends per seat that you get yourself into, and it's really just hiring somebody outside to do the boring, repetitive, almost having to talk to somebody like a 4-year-old training on these pieces that, there's a lot of ways to look at your own database and obviously use data. But I think at the same time, very few people run reports themselves or do anything like that. I think some of them need to be reminded, because you can have the best software in the world, but if they're not using it, or only 20% of the people are using it in 2024, that's a problem. You just need the outsider to come in and train and reinforce, not their trainer. It's just, I've been there. We tried to train the app forever. It's somebody needs to be a little bit more awkward and out of their skin. And I think going back to the AI world, it needs to automate the easy stuff that you feel comfortable doing, because all that money is made where, Mike? Outside the box, right? Outside the comfort zone.
But the thing about it, have you heard of that saying, the devil I know? If everybody's working on the devil they know, because comfort is the enemy of greatness. And I think that, if you're doing what you think you know to be true all the time, and then AI it brings you a little bit of discomfort, so you only, you're dipping your toes into the AI water. We'll create this minor thing and this minor efficiency, and this is what does it work? Yeah. I mean, you can test the water. You know the water is cold, so why are you just dipping your toes in it? If you're gonna do the polar bear plunge, then plunge in the water. I think that you need to be able to sit there and go, okay, this is how it's actually going to benefit if you're an originator and you have a team, this is how it's going to benefit my team. And if you are a regional and you go, well, this is how it's going to benefit all of my originators. And if you're the C-suite executive, this is how it's going to organize the systems, create the efficiencies for fulfillment. And this is how we're going to make underwriting better. And this is going to make originators better. And we're going to implement this to make, to sync our calendars. This is quiet time. This is not quiet time. This is submission time. This is when you can talk. And this is when the originators are going out to originate business. And this is when they're doing submissions. All of that can be done potentially with the syncing of AI together, as long as everybody can get onto the same page. And I think there's the disconnect that we're looking at right now, is that there's a tremendous amount of fear of, well, we're going to do it this way. And that's why you have checkers checking the checkers. That's why you have all these financial inefficiencies, is because everyone's dipping their toes in the pool and they're not willing to get wet.
Yeah, and I mean, so here in the new year, I think, listening to what you're saying, something sparked in my head. AI is something everybody has access to learn more about at a faster pace than anything I've ever seen. And you have all of these leaders at mortgage companies, and I would challenge, has any of them brought all their loan officers together, all their processes, all their underwriters, and say, what are you guys learning? If you took that collective knowledge, because I guarantee everybody is 10, 15% into a good idea and then had to stop because life distracted them. But you stack all those together, and you might have a manual or a blueprint to lift your efficiencies by 7 to 12% with no cost, because everybody talks about culture, the people. What's the advantage? For a lot of these companies, it's going to be people, because they're going to lose on technology. There's companies that just have too much money or too big of an advantage. Zillow, Better, Loan Depot. So you get, publicly traded ones. I'm not picking on any.
The hardest companies are going to be, but Michael, the hardest companies that are going to be working on to actually implement are going to be the publicly traded ones.
Right. And I'm not saying underwriting. Look, underwriting's AI, great. We're going back to our original thought. If you can take 2 hours off of somebody's schedule on tasks, so that your salespeople have 2 extra hours to sell, so that your processors have 2 extra hours to talk, I think that's where you want to go. And you know what? You might find it in the people that wear your jerseys on the front. They might have already done some research. Nobody's getting them together. This is what Adopt the Brand can do for you. But let's get them together. Let's interview them. You might find this 7 or 8 gems, that you just never asked your own team what they're up to. Or you might find 11 of them are working on the same thing, and determine it's either A, repetitive, or B, if they all got together, they might actually make something that's a little bit unique to your company. Because it's all about increasing the amount of hours you can prospect, so you can increase the amount of numbers, so that everything rises with that tide, which is what I'm buying into what you're saying. Here's a prediction for you. On this show, let's keep throwing them out here. 2024. I think in 2024, tail end of 2024, you are going to see more adoption by lenders of non-mortgage technology because of AI enhancements to it that are able to be applied to the mortgage industry. I think, and I think it's going to be also the mortgage industry finally getting away from retention and selling techniques around house items that people give 2 craps about, which mortgage tech companies have made a living off of, like cleaning the gutters, right? Like, you don't need to connect with me to teach me about cleaning the gutters. Every loan officer wants to be a financial planner but their CRM send out stuff about cleaning gutters and HVAC. So I don't, like let's be real and start looking at what we need to do. So I think just third-party software is popping up left and right, and it's inexpensive. And I think lenders are going to start to be able to use it because it's going to advance so fast. It doesn't necessarily have to be a mortgage product. I think you'll see more of that. And I think it'll be little micro SaaSes, like the ability to.
So we've seen a huge dip in interest rates, dropping 1% in the last month or so, as a result of the Federal Reserve's announcements and speech by Chairman Powell. And we're going to see more originations. We're probably going to see more purchases because that's public information when Chairman Powell speaks. We're probably going to see some refinances. So, and on top of that, with the rates dropping, we're probably going to see more gain on sale and gain on margin on secondary as a result of these drop in rates as well. And then as a result, there's going to be more origination, and as a result, more profitability. Is this the year that they invest into the software and into technology, Michael? Or is this the year they just say, we took all these losses, we need to distribute some money back into the pockets and I don't mean this in a negative way. I mean, are we going to line our pockets and wallets again because we have profits, or are we going to reinvest it into more technology, better marketing, and more efficiencies so that as the rates begin to drop over the next year and a half, potentially, because there's a potential that the economy could fail, and if that does happen, we're going to invest so we can remain more solvent and be a better company.
I don't think anybody's more in tune with where that investment should go. There's winners out there right now that would love some investment from some lenders. It's the next wave of the billion-dollar companies. I can provide access to it, and I call CEOs of lenders all the time, probably. I would say there's no appetite for that right now. Their appetite is to find something that is working and copy it. Not in a bad way, but just say, show me something that's working. Show me an ROI that's actually proven. Because we had this problem with easy mortgage apps, and I think a lot of vendors have this problem, and I think it's a difficult industry, lenders. So say why. The problem is we didn't have a North Star, a goal from when we first started of what the KPI was going to be on ROI that we could prove if they took it away, they wouldn't get. And so we brought a doctor in that analyzed over 10 clients, all that did more than 170 units a month, and found that 90% of them, 9 out of 10, there was a 15% better retention from lock to close when they were on an app. Mm-hmm. And it closed 15% faster. Wow. I could say all day. That's because we saw them. The median person logged into our app, which invented the pizza tracker in mortgage. Before Domino's came out with it, Domino's actually looked very similar to ours a year and a half later. So I know a lot of people came after Domino's, called it a pizza tracker. Pizza Track came off after us, and it was because of lenders' ideas. But look, they went in like 27 times, and lenders could never understand the consumer actually would go in like 14 times a day and be totally satisfied with nothing changing. The lenders and brokers and are so obsessed with the idea that customer satisfaction is things always have to move forward because we are a sales culture. But a lot of it is just they're nervous, and it's a suppressant of fear that something could go wrong in a transaction they don't know. And so they were very happy. And my point is, if we took out the app, I feel like no customer after is going to say, you didn't give me anything to log into 27. Or, that felt a lot slower. If you had an app, it would have been faster. Or when I told the lenders this, they said, well, we did get a new coach, this new sales coach. That's probably what it is. You think? I'm not. Okay. And I think this goes for almost every vendor in the industry has had or has trouble proving it. Or if they could prove it, it was a refinance like alert. And now in this purchase market, they're having a lot of hard times adjusting to it, right? But
I want to agree with you so badly. I just can't all the way. Okay. Okay, and the reason is because of this. Okay, so for example, if you work with Caliber Wholesale, they have H2O, and then if you work with Plaza Home Loans, they have what's that? Freeze, or I don't know. They Ice. I don't know. There's some other system, and if you work with anyway, there's a what is it? And there's a number of IMBs that do wholesale and retail, and it doesn't matter. It doesn't even matter. My point is that you have IMBs, whether they're doing wholesale, whether they're doing retail, they have their own. In addition to using Encompass, in addition, or if they're brokering, in addition to using LendingPad or Points or whatever, Arrive or whatever LOS platform that's on there right now, is that you have multiple IMBs and you have brokers and you have correspondent IMB lenders that want to create their own LOS, and then in that LOS have their own AI that's doing that. And everybody's on the same platform in the same language. Everybody wants it to look the same, but they're all inefficient. Instead of everybody collaborating together and say, look, we just need to have, and Encompass has effectively done that, but inefficiently done that. So I think that if everybody just said, "Hey, look, we want to do this and we want to do that," when the banks wanted to get together and create a payment system to combat with PayPal and to combat with what is this the other app that people transfer money together on, Zelle. That's what they did. The banks got together, created Zelle, right? And now you have it's better than FedNow in the sense of getting your money, because when I get money from Zelle, it's immediate, right? So in the same sense, it should be very similar to what you're talking about with the loan tracker and the Domino's pizza tracker. Nobody's getting together like, hey, let's bring Loan Depot, Guild, Rhythm, and Rhythm owning multiple companies and whatever, and say, this is what we're going to do to create efficiencies. Because the best system I've ever seen as an originator was the one that came out 16 years ago with WJ Bradley. They had it down to underwrite, from 10:03 to submission down to like 6.7 hours or 28.8 hours, or from loan estimate to doc to submission. I mean, you had it down to the wire. And Shearson, Lehman Brothers, owned that software. And then when the crisis happened, I don't know what happened to that software, but it was the best origination systems that I've ever seen as far as efficiency was concerned, as far as getting turn times and getting things done and communicating, because you could also move the loan to the pipe as well. And I know with Caliber, when we did that through H2O, it was similar, but it didn't have the same efficiencies. And the same thing with some of the other wholesale platforms I've seen of what regional managers could do with their pipeline. And it's that type of inefficient management that you can create with AI now, saying, hey, tell my AI to program this so that we can have faster underwriting times, have our pre-QC checks for this, and so on and so forth. And there's that inefficiency that's happening right now because they're afraid to remove the checker of the check. Sure.
Just to break it down, what you said, a couple quick things. One of our listeners, Birdie, we'll call the Blue Jay, told me from a high person they know in national banking, that the checking account apps used way more per day than they thought.
That's right.
And my guess is they probably thought, okay, they're only going to use it with big transactions. Now they're checking it even without a transaction. Why?
That's eliminated the VOM. I mean, the VOD. Right? You don't need a VOD if you get all that.
They still haven't figured out. The real winner in this whole game is going to be if you can somehow send your VOI from inside of your banking app back to the mortgage company. I think that would solve a lot of the problem. But digress there. If anybody in the audience has an idea around that from any country in the world, give me a call. So I'm working on something with Henry Santos where we were bringing SAP to the market.
Okay.
And listening to him talk, the major problem with the whole mortgage industry is the LOSs are built on outdated software. If you are obsessed with global manufacturing, if you wake up every day and you employ millions of dollars of salary to create a better manufacturing process, you can't squeeze the orange juice out of the rock or the apple because you don't have an orange. And SAP, Oracle, and IBM, probably examples of it, but ERP software that are built for manufacturing. And until something is built on it, you have traditional LOSs. Have you ever noticed they all look like Excel sheets, like rows and tables, even though they're not, like with fancy lipstick on them?
Yep.
But if you look at them, they all have fields, right?
Yes.
If you walked into a chemical plant or John Deere, you would find that each screen, and there's a lot of screens and a lot of machines, and a lot, I know we have compliance here and you might get sued, but in some of these chemical plants, if you put a drop of the wrong liquid in, kaplooey, right?
Yeah, that's
and
right.
They're relying on machines, not people, to even do that. So we are looking for, ideally, to accelerate it, would be 7 to 10 lenders willing to chip in to get the cloud service, and then they are actually going to do a lot of the building for a base total project. And I think the key to this, and what you said, Mike, that stood out to me is, unlike any other project in the world that has come into mortgage, it would rely on what you said. They would have to be in agreement that this is the out-of-the-box solution that we're all going to go all in on, because the more we each try and do a special sauce out of it, the more we hurt everything. And that's been the problem. If you think about it, the mortgage industry has managed to waste trillions of dollars, I think, over the last 6 years in money that could have went to them, that went to technology founders, or just went nowhere to developers and everything for technology for them. But now the company's barely hanging on, or there's 18 of them left, and we know there's only going to be 2 maybe in 2 years. And I think a lot of it is there's been no LOS that comes out of the box. Here's how to close a loan. You can set up your milestones, right? You can add your disclosure system, not here's how it's going to be, because we know that's never really sold in this industry, but it's set back, just like you said, Mike, it's set back the industry because so much money's spent on everybody doing their own secret sauce. And at the end of the day, it sure sounds like they're all in pretty similar points throughout 2023 when we were talking, right?
Yes.
So I agree with you. I think that's, and going back to in 2024, will there be an investment? I think, and going back to what I said, if you're the lender and you're assessing a vendor, let's take all these ones that show Ingenious, Mortgage Mobility, right? Emergent. It's table stakes, because if your recruiters don't have it and we're in a loan officer market, it feels like they're behind in being able to recruit. But the business plan is obviously those companies want to sell it to loan officers to go out, target who the realtor's using, and then be able to say, hey, you said you give me all your deals, but I noticed you're giving credit unions these FHA deals. Do you not think I can do FHA? Or you might go out and say, hey, we're prospecting these realtors. These ones are the ones doing all the deals. What happens is the loan officers know the successful people in their market, and the ones that from a data perspective look like the ones they're supposed to approach, they're too scared to approach them. They know them from the beach club, right? They went to high school with them. And therefore, I talked to somebody the other day, and he's like, I log in when I see the bill for about 2 days, and then I wait. And that's because, going back to you have to show that if you took it away, that loan officer wouldn't get any more realtors. And it's been very difficult for all of us to do it. And I think that's the only new tech that'll be in 2024. If there's an ROI field component, I have some ideas in my head. I can't say, but I would say it's very difficult. So
if I was to explain this to an executive of a mortgage company, this is how I would explain it. Have you ever eaten a meal that was deconstructed before? And if you don't know what that is, for example, if you eat a hamburger that's deconstructed, that means that you're going to have your patty, your bun, bread, brioche, sourdough, rye, whatever. Then you're going to have some kind of, maybe you'll have some kind of vegetable. Maybe you'll have an egg. Maybe you'll have, some other meat, whether it was pepperoni or.
Is that a thing on the West Coast? You get like your first course is the bread, then your second course is the patty. Then
Well, that's what you call eating a meal. That's what you call eating a meal. It's called a deconstruction meal. I don't know if you ever had that before.
I was following it. I'm saying, is that like other restaurants that do that on the West Coast? 'Cause we should,
There
next
are
week, we should
restaurants.
have our top 10 deconstructed meals. Like, what can you dissect that's actually?
It's like the perfect person who's like ADD and has to eat in a certain way. Well, I'm going to eat my vegetables before I have my steak, before I have my carbohydrate, before I have, you eat it deconstruction style, right? And the problem with mortgage companies right now, that at every level, to what I've seen, is that they want to plan their business deconstruction style. We're going to work on origination platform here. We're going to work on compliance here. We're going to work on fulfillment here. We're going to work on secondary here. And then instead of just like eating it as a big, juicy hamburger. The hamburger is meant to be eaten as a sandwich. And origination and fulfillment is supposed to be done all at the same time. And the problem is like, well, if we're going to, what I've seen is they get tech heavy on this, or they get tech heavy on that, and they are running their business as if they're eating a meal deconstruction style.
I think if the regulators didn't come down, do you think it would be more like? 'Cause I keep thinking about pizza deconstructed, tomato soup, bread, and a bowl of cheese. What do you think?
Well, you isn't that what a grilled cheese with tomato soup on the side and maybe some other salad? I mean, isn't that really basically eating a pizza deconstruction style?
No, because the bread and the grilled cheese is the same as
Anyway,
the pizza.
all right,
But
anyway.
yeah, you're close.
All right.
So does regulation cause that? Like, is that what you think it is?
Absolutely. Of course it does. Because when you have fair housing, you have AML, anti-money laundering, you have anti-fraud, you have, there's like this plethora of compliance that you have to run through in the origination cycle, on top of originating credit checks and credit fraud or all that stuff that, banking fraud and wire fraud and, all the other types of fraud that are out there, not to mention fraud for profit, fraud for housing, fraud, all that stuff that you still have to check for compliance purposes. And meanwhile, you have your executive that's having compliance on that, and then you have sales that's saying, "Hey, we're going to do these originations," and it just so happens in this part of the United States, is the majority of them are Latino, or the majority is Black, or the majority is this. Oh, well, why don't we do more of the Community Reinvestment Act loans, because it's not profitable to the bank, so we're not going to do that, even though we technically could, right? It's just this. You hit the head, you put the nail on the head when saying, hey, is it compliance? The answer is yes, it is compliance. It is slowing everything down, but stop eating your hamburger as if it's supposed to be, as if you're 17 years old, you want to eat it one bite, or stop eating your pizza as if you're having a pizza eating contest. You could have 17 pizzas at one sitting. Just how do you eat a meal one bite at a time? And it's okay to do it slow at the beginning, but stop doing it in chunks, because that's what they're happening right now. If you're an executive and you're giving
if you're
it
an executive, you have to check out this SAP solution, because I think that's the whole point is the architecture has caused everybody to build it like that, and there is no other way. And then it's been snowballed. But the SAP, reach out to me, please.
When they have an all hands meeting, because I've attended their all hands meeting with them before. They communicate. Mike Hardwick and Mike. Both Mikes. Exactly. They communicate not only to their sales staff, but it's a real all hands meeting. They're communicating with processing. They're communicating with secondary. They're communicating with fulfillment, and they've done a really good job. When they have an all hands meeting, and people are engaged. You can tell people are engaged on this with cameras on and so on and so forth. And so when I see that with that particular company, I'm like, oh, because that's the only company I've ever seen that with all hands. Even with Caliber, when I was on an all hands call with Caliber, I was like, this is not really, this is like you can tell every third person was like, I'm here because I have to be, not because I actually want to listen to what my leaders have to say. And I think that's the problem with Rhythm anyway. But I think that if we look at certain types of leaders in the industry, like that company that starts with church, then we can look at it and say, oh, this is what they're doing to communicate with their team. Why can't we at least contact them and say, hey, you know what? We're going to collaborate together with them. And I think, doesn't Henry have some relationship with them as well? Maybe they can get together and say, this is what we're going to do. Let's look at their model and see how they communicate. Even that communication portion that says this is how they're communicating is one step closer to producing a better mortgage loan fulfillment cycle.
Yeah, Henry does work very closely with them. So does the OPX America, the BPO side. There is a lot of learning. You can either be a large, there's just different models, right? And I think that goes back to earlier in the show. The people underutilized because they have so much more ability to contribute these days, especially with AI in 2024. You should be contacting your entire workforce, finding out what they're doing on AI, and stop focusing on underwriting AI. I feel like you're over your skis sometimes. That's why I said 2024 is going to be, look, I'm involved with some serious tech like Redfile, but the lenders, I think, just want to tell me what's working somewhere else, make it easy for me to copy it, meaning buy it, and show me how they're using it. Don't just tell me 30% reduction in XYZ, and I'll do it as long as everybody's cool with it. And that's kind of what you're saying, Michael. And it's find out what many of these companies are doing, like Churchill, and reach out to me. I'd be happy to connect with Henry on that one. That's actually one I'm close to, Michael. So, and Michael's a great resource too. He's been with many companies. Now, Michael, can we talk about, I know we got a couple minutes here. Let's go a couple minutes over, if you don't mind.
All right.
Can you break down for 2024 predictions? Can we go over this article that was sent to me by one of our listeners? Obviously very connected, former Lehman Brothers consultant for many people in the industry. He sent this article talking about higher home prices and inflation in 2024. And do you want to just pull up the article? We can kind of go through it together here. Owners and managers of federally insured depositories. This is also from Wayland Global Advisors, LLC. Well, I'll just kind of read it to you. But a year after the near-death experience of trillions of dollars of unrealized losses on COVID-era securities and loans, the U.S. banks were handed a nice zero-risk trade. What he was saying was the one-year swaps declined to the point where they were giving them risk-free arbitrage opportunity at the Fed in the past couple of weeks. So here's an acronym, BTFP, which stands for Fed Bank's Term Funding Program, prices off of the one-year overnight index swaps, OIS, not iOS like an Apple phone, but overnight index swaps. The interest rates were 4.85%. This morning, banks are buying funding from the BTFP, Fed Bank Term Funding Program, below 4.85% and selling Fed funds at 5.5%. Back in September, the BTFP Bank Term Funding Program, this is how we learn things, listeners, was the trading near 5.5%. So the trade's worth more than 3/4 of a point risk-free.
Wow.
Want to talk about that at all? Or do you want me to keep going?
Without having that article, it's a little bit more difficult because I was looking for it right now. I actually don't see it.
So he says that the growing popularity of the program means the Fed is likely to discontinue the BTFP in March as currently planned.
Because it's a win. It's a win. It's a profit center if you are trading that, either on Wall Street or at the IMB level.
And so what you're going to see, I think, is good news up till March from what we're hearing, especially around commercial real estate, because this gives the banks a little bit of time to fix the ship, it sounds like, which obviously affects everything from mortgage to car loans to commercial real estate.
Well, think about this for a second. If you are a commercial mortgage banker, right, outside of that swap itself, let's look at that's like you're at the shore and you're watching the waves come in and going, this is awesome. I get to enjoy the beach. But you don't see the tidal wave that's about to come and destroy the beach. The tidal wave are the balloons and the arms that were originated 10 years ago, 11 years ago, or the ones that are a little bit more short term. 3 years ago, that are getting ready to crash onto the shore. And if there isn't an instrument to help them modify the note for an extra 12 months while the economy gets back into gear, then that's going to cause a commercial meltdown, which increases unemployment. Right. So this is one way, potentially, without me getting too deep into it, to mitigate some of that risk and to help bankers create some profitability so they can offset some of those commercial loans, so that if they balloon, they can actually modify them knowing that they have some profit center they've created in another T account to offset any losses, to either do an extension or modification to keep that loan in check without forcing a foreclosure. Because everything nowadays is about how do we get the paper out, but how do we even more so create profitability or not have as many losses or mitigate our losses. And so in seeing that until March, hey, you know what? With all this stuff going on, it looks like it's going to either be a refinance or servicing blessing, saying we actually have the money to actually go and do it because we already have the manpower to do this. Let's actually use the manpower and either do extensions, modifications, or new originations in refinances to get this paper. Even if it's at a higher rate, it's still better for the investor, the real estate investor, not the bank investor, but the real estate investor, to extend the loan rather than go through a foreclosure or deed in lieu of foreclosure. So that's good news on that front.
In 2024,
yeah,
for lenders to map out what's going to happen with a June decrease in rates, sort of like what, and October. And that's just half of Mike and Michael. This is Mike's prediction here, Mike Kelleher.
Yeah.
I think March found money, but if you're not organized for a huge June drop, and that's the part that I'm working on with lenders when they, is I think one, they reach out to adopt the brand, and we obviously have Michael's ties with the family office and the ability to consult on how to increase your product set in case rates don't go down. And then what I'm trying to do is money back guaranteed on this one, but help you come up with a plan for June and for October when it drops to catch every refinance possible. Because what I'm hearing is, don't forget, so many have consolidated, moved, changed, secretly drive, Uber or something. I mean, what do we say? 88% are doing less than a deal here in the November, December. They're doing other things. So when that rate refinance super drop happens, and it might be short-lived, it's going to feel so much bigger than it is. So you got to stop concentrating on the large trillion, $2 trillion, $3 trillion numbers from the MBA when you think of how you're planning this out, because it's going to feel like a fire hose, because all those people that were taking orders in COVID, a lot of them are gone. So it's all going to go to, can you capture them again? And I say June and October because I feel June could happen, but I also see, and this article talks about the confusing message and continues, where Fed Chairman Jerome Powell, kind of has this problem where the rest of the Fed, the FOMC, Federal Open Market Committee, loves to talk to the media these days, unlike before. And they're all kind
because they got better news.
Yeah, and it says that they're kind of contradicting them here, but it says the market's saying that Federal Chairman Jerome Powell's voice is the only one that matters. So now that's pushing the 10-year down, everything down. And then when I see the mortgage industry, my LinkedIn feed, it's let's ignore all the other FOMCs because the market's ignoring it. And that's where you get yourself into trouble. I think if you're going to see mixed messages, yes, good momentum, June. But I'm also hearing from the Rockin' Rob and the Birdie, they never were quick to raise rates. They're probably not going to be quick to lower rates. They're probably going to hold it off till the commercial real estate drops. And we're hearing in 2024, you could see 300 to 2,400 community banks close, is what my Rockin' Robin's telling me.
Mm-hmm.
That's a disaster, right? And maybe they'll be able to hide it as a merger, but it's going to be bad out there. And I think the only way to solve that is cut rates. So I think if they know that, or if I'm hearing that, and that's what DC's telling them, then I think he's not there to save the mortgage industry. He's there to save banks, and he might hold on to these, maybe give one rate cut, but hold the others till the commercial real estate crashes.
Yep.
And that's from a valuation standpoint. A lot of these
Sure.
loans will be written off. They're actually well underwritten. They're just the appraised value is just totally off. So they just need to be written off, repurchased by different Wall Street investors, put back out on there on the market, better lease programs for commercial people trying to compete with Amazon and actually be able to have a storefront again and afford it, and a big recycle. But it'll be a messy end of 2024, all of 2025 before good days ahead in that world. And
Yes.
they're going to need a lot of rate cuts to battle that because it's a banking problem, right?
That's right.
Because if you look at what the Federal Reserve is, and I actually have two charts pulled up on my computer here. The first chart is all the federal overnight lending rates and what they've done in raising rates over the course of the year, and then you see what is the yield that of the 10-year Treasury, and it's gone up way faster because it wasn't about what the Federal Reserve was doing; it was about the debt ceiling. And so, two things are going to be taken into consideration over the next year, because we're going to be talking about debt ceiling more and more as we get into the election of next year, and as we talk about the economy. Maybe we're out of time for this right now. Next week we can actually talk about what may happen into the economy, debt ceiling, election, and how many times we think that the rates will go up, or even more so, what are rates going to do, and how is it going to, and how is that basis points going to be potentially more profitable in secondary back to the IMB, so that they can say, based upon this week's conversation, can they invest into infrastructure back into to be a growth company as an independent mortgage banker? And I think that is a great lead in for next week, Michael, as we cap off the show.
Yeah, next week I'm going to work on getting some guests to talk about with Michael some real capital markets. So we're going to try and make half the show capital markets, maybe half the show get some inspiring coach or sales leader to help with goals in 2024. But like Mike said, we want to break down, where do we see housing values go? What is the difference between a teaser rate, so loved by the media, and the effective mortgage rate? What was the effect of quantitative easing? What are some of the more underlying factors in mortgage that you're not seeing in the headlines? A reason to come here. And we are going to have some special guests. I'm going to send out some invites, so we are expecting a larger LinkedIn audience audio than usual. But if you're trying to find us, LinkedIn Audio Live, 2 p.m., 11 a.m. Pacific is where we do our live taping in front of a studio audience, virtual.
Yep.
And then we have it replayed, rerun on our YouTube station. It gets the live drop, as well as it's being put on Podcastle, Spotify, and other great areas to find it. And we're starting to get a lot of action and a lot of audience participation and questions. So we're excited about that. Thank you.
Absolutely.
Happy New Year.
Happy New Year.
For joining us.
Yeah, Happy New Year. And it's going to be a Happy New Year, not only for our show, but also for Adopt the Brand. Wouldn't you think so?
I think every lender could use an outside voice that wants to bring together
Absolutely.
whatever role that is, bringing them together like you talked about on this show today, Michael, and doing it through making sure they're adopting all of the technology and then find out what they have adopted on their own and bring it back. I think that's where you get ahead in 2024. And I don't see anybody else but Adopt the Brand reaching out to say, let me help, let me work alongside you. So I think that's going to be a big initiative for a lot of lenders in 2024. If it isn't already, you know me, it should be.
Yep. And let's plan next year, Michael, to do one of these shows live at one of the MBA shows.
We'll have to do our research which ones fall on a Thursday, and we will be there. Thank you, Michael, for another amazing show.
Thanks. Happy New Year. See y'all soon.